In a housing market as hot as Seattle's, some investors are targeting absolutely massive returns in just 6 months. So how are they pulling it off? In this explainer, we're going to pull back the curtain on the blueprint for a high-stakes fix-and-flip model. We'll dig into the strategy, the legal safeguards, and, of course, how the money actually flows.
So, let's just jump right in with the big question. A 50% profit on a single home flip? I mean, that sounds almost too good to be true, right? But it's not just some hopeful number. It's the target outcome of a very specific investment blueprint, one that's designed from the ground up to maximize returns while keeping a handle on risk.
And to really understand how it works, we've got to look under the hood. It really comes down to a combination of 3 key things. First, the unique dynamics of the Seattle market. Second, a pretty clever legal structure to protect the investment. And third, a set of financial terms that gets everyone's interests pointing in the same direction. So let's start with the market itself. First up, why Seattle? Because, look, a strategy this aggressive doesn't just work anywhere. The opportunity is completely tied to the unique economic environment of this one city, where the basic rules of supply and demand are, well, they're supercharged.
It all boils down to that classic Econ 101 lesson, supply and demand. Seattle's booming tech economy means you've got tons of people with good jobs all looking for homes. That's huge demand. But at the same time, there's a very limited supply of houses. That imbalance is what pushes property values up and creates the perfect storm for a profitable flip. And that brings us right back to that eye-popping number, 50%. So what does that actually look like? Well, imagine buying a property for $1 million, then putting another $200,000 into renovations. In a strong market like Seattle's, the whole goal is to turn around and sell it for a high enough price to generate a 50% profit on that entire project cost. But how do you protect that kind of investment? Okay, so the potential for high returns is definitely there. But what about the risk? This is where the legal setup is absolutely key. The entire model is designed with what you could call a protective bubble to wall off each individual investment from everything else. And the way they do this is with a legal tool called a special purpose vehicle, or an SPV. Now, the easiest way to think about it is like a separate, fireproof safety deposit box just for one house. A brand new company, an LLC, is created for each and every property. This isolates the investment, which means if one project somehow goes wrong, it can't drag any of the others down with it. And here's how that whole loop works. It's pretty straightforward. Step 1, investors put their money into that special new company, the SPV. Step 2, the SPV uses that cash to buy and fix up the house. Step 3, after the renovation, the SPV sells the finished property. And finally, step 4, all the money from the sale flows back into the SPV and then gets distributed out to the investors. It's a really clean, contained, and transparent cycle for each deal. Okay, so we've got the right market, and we've got the legal structure. Now for the part everyone really wants to know about, the money. How do the terms work, and how does everyone actually get paid? Because really, the details of the payout structure are what make this entire model tick. This table breaks down the core terms. First thing you'll notice, the hold period is just 6 months. We're talking a really quick turnaround. But now look at the preferred return, 15% annualized. This is a huge protection for investors. It basically means they get first dibs on the profits, up to a 15% annualized rate of return before the major profits get split. And only after that, whatever is left is split 60-40. This whole process has a name. It's called a profit waterfall. And the easiest way to picture it is to think of filling buckets, but in a very specific order. All the cash from the sale first goes into filling bucket number 1. That's returning every single dollar of the investor's original capital. Only when that bucket is totally full does the money spill over into bucket number 2, paying out that 15% preferred return. And only after that bucket is full does the rest of the profit flow into bucket number 3 to finally be split up. So what does that look like in the end? This chart gives you a pretty clear picture of a final profit split. After all the initial investment is paid back, the investors get their preferred return plus their 60% share of what's left. The manager gets their 40% share, which in the industry they often call the promote. You can think of it as their success fee for making the whole project profitable. Now, this whole financial structure, it's not just about the math. It's really a carefully designed partnership on paper, and it's created to ensure one absolutely critical thing, that both the investor and the manager are rowing in the exact same direction. So here's how they make sure that happens. The investor is protected, right? They get their money back first, plus the preferred return. Meanwhile, the manager is highly motivated. Not only do they have to invest a good chunk of their own money, giving them real skin in the game, but their biggest reward, that 40% promote, only kicks in after the project is successful enough to pay back the investors first. Their goals are perfectly aligned by design.
All right, let's put all these pieces together and just walk through what that entire 6-month journey looks like from an investor's point of view, from the first wire transfer all the way to the final payout.
You can see the whole cycle is built for speed and efficiency. Month 1 is all about setup, picking the right property, signing the agreements, and funding that SPV. Then months 2 through 5, that's the execution phase. The manager is handling the renovation and investors are tracking the progress. And then bam, by month 6, the goal is to have the house sold and the capital, along with any profits, distributed right back to everyone.
If you take away just one thing from all this, let it be this core principle. The manager earns their big payday only after the investors are paid. Everything, the waterfall, that profit split, the co-investment, it's all built to enforce this one simple investor-first alignment. So we've seen how this model uses that SPV structure to create a kind of protective bubble around each deal. And it's a really clever way to isolate risk on a project-by-project basis. But that leads to one final, really crucial question. What happens when the risks come from outside that bubble? In a rapidly changing economy, things like interest rate hikes or a sudden market downturn can impact everything. It's a powerful reminder that no matter how well structured a single deal is, it never exists in a vacuum.